Good morning, everyone, and welcome to the CoC training series. This is our third session, and today's topic is income and rent calculation. I posted a little message in the chat, and in doing so again, the housekeeping notices. Yes, this training is being recorded, and we will send you the slides and some other resources. As for questions, we welcome them. You can ask them as we go, and we hope to have some time for Q&A at the end. And then also, sometimes people ask questions that preempt upcoming content. If that happens, I may address the question then and there, or ask that we wait until later in the presentation. And yes, my name is Wes Brimmer. I am a CoC grants analyst, and my manager, Megan Tanikunath, is also on the call, CoC grants manager. Today, I will be the main presenter, and Megan will jump in as necessary, and she's also monitoring the chat. So please expect written responses from her. Awesome. Well, we'll jump right into the topic, income and rent calculation. So picking up where we left off last time, it was all things enrollment. So program agreements, grievance and client termination policies, and signing those documents, and then also some of the VAWA forms that are given at program enrollment. So now we're ready to sit down with the household and calculate their annual income and see how that determines their rent contribution. And there's a lot of intricacies involved in that. So be prepared for us to go in multiple directions, because we do have different project types, PSH, RRH, and TH, and some of the needs are different. All right, with that said, let's kick it over to the slides. Just gonna get situated so I can see you all. Yep, feel free to share your video if you like, but not at all required. All right, so our plan for this training is to hit some of those big question words: why calculate household income, when, what you need to know, and how. The first three topics will go quickly. The fourth one will have a lot of elaboration. So why are you calculating income with the household? First, it helps assure that the household is paying an appropriate and sustainable share of the rent, or if in question, the occupancy charge. Secondly, this helps support quality case management and may help your household get connected to other resources. This is a pretty cool talking point I was reading in the data quality standards by HUD, and they shared that the ideal approach to the income and rent calculation worksheet is to go through each of these income sources and ask the client if they have that type, going through all 7 of these, all 8 of these. That way, maybe the client forgot about an income source or didn't think about it, or it's a possibility for them to pursue, and maybe you with the client can pursue that new income source. The alternative is for you to simply ask, what are your income sources? And maybe the client will overlook or forget one of those. So I thought that was a really cool suggestion from the data quality standards. Other reasons why to calculate income. Yes, for HUD and IHCDA, and maybe for your purposes too, you want to see how the households are increasing or decreasing income in their time in the program. And of course, income may stay the same, but it's very important for data purposes. And yeah, we also need to follow the rules, right? you're calculating income to comply with CoC regulations. One reason you are not calculating income is for participant eligibility. CoC has no income requirement, and there's no upper cap to the income the clients can earn, which is very different than a good number of other HUD-funded programs. But let's just be clear, at least for CoC, calculating income does not really feed into client eligibility determinations. So you'll see this on the worksheet too. On the worksheet, you have check boxes next to initial calculation, annual calculation, or interim. So that kind of begs the question, when do we need to calculate income with the clients / households? All right. Very clearly at program enrollment, for every household, whether it's TH, RRH, or PSH, you're calculating the income. Also, this gets into the interim calculations. When a household reports a change in their income or a change in the composition, for example, the birth of a child or a dependent turns 18, then that may be a moment for an interim income calculation. Also, for all three project types, annual assessment, or some people call it the recertification, income calculations are in order. They're required at those moments. And then we do have to provide some nuance here to this slide. At program exit, you may not pull out the worksheet I just showed you, but when you're doing an exit assessment in HMIS or DV client track, one page in that exit assessment is the income sources, and you're also putting the amounts of income. And that is a required part of the exit assessment. So we want your compliance there as well, but we just wanted to stress it's really not like you're using the income calculation worksheet. And then Megan brought it to my attention, sometimes clients don't give you an exit interview, and we know that that's a reality. So we encourage you to use your professional judgment in those situations. For example, your last case management meeting was maybe 2 weeks before the client ghosted you, right? And you, during that case management session, you checked and the income had stayed the same it had been for the last year. Well, use your professional judgment. Do you think it's timely and accurate to put those income sources in, even though the client ghosted you? I'm not going to say what you should do, but there is professional judgment you need to exercise, and it could be reasonable for you to enter those data figures that you had from 2 weeks ago, even though it wasn't part of the formal exit assessment. Okay. And a reminder that we're here for questions too. If you get those intricate situations and you want guidance from us before you act, we welcome that. And then, yeah, in case you want to read the regulations for yourself on how they comment about when income calculations are required, the references are down there. I'm going to skip this last slide because it's just simply providing you the regulatory language, and yeah, reiterates much of everything I just said. So you can read that at your leisure. All right. This is a busy slide for sure, but when you go to the income calculation worksheet, there has to be some knowledge behind your eyes, right? And so I wanted to create this slide to encourage you and affirm you that if you're well established and confident in your income calculations, really you should be proud of that because they're quite intricate and there's a lot you need to know. And it's even a skill to know where the resources are, where in the regulations to look, or where on HUD Exchange. So by all means, I want to uphold that income calculations can be difficult, and if you do them well, then that's a lot to be proud of. So I won't go through these bullet points now, but we are going to be unpacking these insights as we walk through the worksheet. Okay. Just want to speak to for a moment on how much different households or different project types should contribute to their rent payment. PSH is the cleanest cut, really. If a PSH client has income, the client must pay the higher of 30% of adjusted income or 10% of gross income. And this is baked into the worksheet. So that's another thing about the worksheet. It has a lot of the background knowledge that you would need anyhow. Now, for TH units that are funded with leasing dollars, if the program has clients pay an occupancy fee, then at most the rent can be, or the occupancy charge can be the higher of 30% of adjusted income or 10% of gross income. So I know we have a few transitional housing projects. If you are not at all charging an occupancy fee for your residents, then this really doesn't apply. And if you want to go deeper with this middle insight here, you have the reference. And then probably most challenging for me to describe is rapid rehousing, because rapid rehousing, yes, we, the Indiana Balance of State CoC, we have our written standards for rapid rehousing that gives kind of wide license and general guidelines on how rapid rehousing clients will progressively increase their rent over their time in the project. But each agency can take this in slightly different ways. So because there's so much diversity, I really can't helpfully comment here. So this is another moment when I invite, if you want our guidance on how you're framing the progressive engagement model, please contact Megan or me. Okay, so like I said, in quick succession, we described the first three elements, and now on to how to calculate income. This slide is intended as a general overview of some of the steps, going beyond the worksheet that we'll work through, what it may look like. So by regulation, every household, they have to have income source documents. So those pay stubs or benefit letters really vouching for how much income they have. There's no way around this. They are required. So maybe you task the client with gathering those documents before your case management meeting. Okay, so that could be a step outside of the meeting. And then the second step is what I've described, the sit down to calculate the income and deductions. And you may be calculating income at a time when the client hasn't even begun to look for or locate a unit. So I just want to stress that the worksheet, sometimes you may have to revisit it. You calculate the income at one time and then you come back to it. to determine the rent contribution. And yeah, so I will say this slide is kind of geared toward more of a tenant-based rental assistance approach. And in a moment, we'll see the worksheet. And there are four main parts: the income, the allowances, and there are 5 different allowances, 4 or 5 depending on how you count them, and the rent contribution, and lastly, the utility allowances. This section applies if the client has standalone utilities, utilities that are not bundled into the monthly rent charge. So, okay, I wanted to create a small discussion moment before we head over to the form, to the worksheet. I think the worksheet as well will bring about a lot of questions. So, so that we can all kind of look at each other, I'm going to put the question in the chat. All right, and then I'll read this and then give you all about 15 seconds of thinking time before we hear from the first person. It's time for the initial income calculation for a PSH household. The PSH household is assisted by CoC rental assistance. The head of the household's wage will soon jump from $12 an hour to $14 an hour. The head of household has a letter from an employer verifying the pay raise, which will take effect 2 weeks from today. From an income and rent calculation perspective, how would you handle this situation? Give you about 15 seconds to think. Okay, I saw one person chime in the chat. Michelle, you would change this at next lease renewal. Okay. Christina says use the current income. Lorraine change at the next research, which agrees with Michelle. Use last 60 days of income. Okay. All right. I think my question was too vague, so I am going to reframe it. And life isn't black or white, so please don't hate me too much for giving you a binary, an either or here. And I like all the thoughts here. Okay, so clients is going to get that, we suspect. I mean, the employer's promised to give a pay raise in 2 weeks. So right now, you need to do an income calculation. On the income calculation, do you think you would go ahead with the $12 per hour that the client's currently earning, or would you do the initial income calculation with the $14 per hour? So in the chat, if you could just put 12 or 14, I think that would, okay, some people are already ahead of me. Okay, wow. A consensus. Everyone says 12. Okay. We have one. Okay. $12 per hour. Is someone willing to come off of mute and explain why you said $12 per hour for the initial calc? Okay. Lisa, go ahead.
Want to use what is currently earned, not what is promised, because at this point they are not actually earning that dollar amount. So there's no way to calculate that gross income because at this point it's not being earned.
Correct. And let's take it a little bit farther. What would the client's first month kind of look like financially if you calculated at $14 per hour, yet for that first month, at least the first 2 weeks of the month, they're still earning $12 per hour. Okay, it'd probably be a hardship for them. And also from a compliance standpoint, you wouldn't see that first $14 an hour paycheck until at least a month from today, assuming bi-weekly pay. So, yeah, okay. So kind of the best way to proceed for the client's interest is $12 an hour for the initial calculation. And then if the client wants you to revisit once the client has those $14 per hour pay stubs, then an interim calculation could be in order. Okay. All right. Awesome. I do have the answer typed up, but everything we said is a lot more detailed than what, yeah. Um, so, okay. Thank you for your feedback there. All right. Ready to transition to more of the how? Oh, great question. Yeah. What is the purpose of completing a rent calculation before housing has been identified? That's a great question. Okay. Um, Megan, feel free to chime in here. My initial thought to this, and this is not one I've pondered, so um, I'm thinking of uh, a tenant-based rental assistant situation where client has to find a unit. Um, you want to calculate the income mainly because it's required. It's a programmatic requirement. And yeah, I mean, if the client were to drop out of the program and you hadn't yet calculated income, then you're missing a data piece, is my initial thought. But if you have strong indication that the client's going to stay with the program and you'd rather delay the initial income calculation until they've secured a unit, you can proceed that way.
Yeah.
But
What?
go ahead.
Sorry, Wes. I'll jump in here. So most, I would say 99% of the time, you're not going to do the income calculation until the unit's been identified because you need to know the rent calculation. In this particular program, since income is not a program requirement, like however much money they're making is not an income requirement for that for program eligibility. However, I do think it's important to have a general idea up front if the client does have an income, because that can also help inform which unit um, you're looking for and like the unit search process. So especially in like RRH or THRRH programs where there's like a stair step, maybe you pay rent for the first 3 months and then the client starts participating in their own rent. In that situation, I do think it is helpful. Maybe I think we can leave it up to you whether you do a full income calculation on the compliance side, doing it at the actual rental, like when a unit is identified, is sufficient. However, it's important for case managers to know what they're working with. So if a client has zero income, they will be eligible for a lot fewer options than if somebody has income. And so it's kind of going to depend on your program type, and it's going to vary from client to client based on what they need. I know that's a very long answer to a short question. No, it's not required until the rent calculation. However, it can help you during the unit identification. And I think that's our topic for the July training, identifying a unit, how to determine what works best. We'll get into that at that time.
That is our July topic. Yes, thanks. One other thing I just want to add, I'm not going to elaborate. You do have the entry assessment in HMIS and DV client track, and there is the income page of that. So like if you want to synergize and go ahead and do the income calculation at that moment, I don't know if that's feasible. If you dislike that idea, then disregard. But there is another moment enrollment where you're already considering income. So thank you for jumping in there, Megan. All right. Grab the right screen. Okay. We're going to go through this worksheet, but I kind of need to be clear on my purposes. It is not for me to go over every part of this very long worksheet. It's to give a general overview and kind of tease out some important or possibly overlooked details. So kind of just highlights, and feel free to ask questions as we go along. First, this worksheet is posted on the CoC webpage, and by that I mean the one on the IHCDA website. And this was designed to serve all three of our project types. So I already spoke to this piece here, initial, annual, or interim calculations. The instructions here speak to one of our previous topics, when to complete this form, when to calculate income. And then, we wanted to put a friendly reminder that the income source documents, those pay stubs, benefit letters, they're all required by regulation. So you could think of this as both a worksheet and a cover sheet. When you tuck this into your paper client file, maybe the documents to follow are those income source documents. That's just one way of proceeding. Moving on to the first section, you're going to identify all the different types of income, and you are going to annualize. This is going to be a projection for the next year, kind of from the moment you're doing the calculation, and project a year out. So there are some parallel documents that I want to highlight before we go on. So we see 8 main categories of pay, and best practice to ask the client about each of these. But sometimes we get a very atypical source of income, and you're not sure if by CoC regulation, by HUD regulation, that income should be included in this. So this is where we pop over to the regulations, and these will be included in my follow-up email. But so it's part 5 of HUD regulation, and then page 609. So you have here a general description of what should be included as income. And then they provide a long list of 28 exclusions. So a good feature is Control F. You can do a quick search, or if you're new to income calculations, it might be nice to spend the time to read through all 28 exclusions and have a general idea. And then when you hit those atypical situations, you can pop back here and reference, oh, this should not be included in the calculation. So that's one of the best resources to go along with this worksheet. Another fruitful collaboration moment was Megan really drawing my attention to foster children and foster adults. So as we go through this, I'm going to speak to how foster children kind of are impacted by this worksheet. So first thing to know is you do not count the income of foster adults in this rows 1 through 8. And then the other thing I wanted to highlight on this first row is that if you have a full-time student 18 or older, you do actually report the first $480 of income that they make. And that's kind of to offset if they were claimed down here as a dependent. All right, moving along, you have your different forms of income. One thing to highlight is for Social Security, annuities. Sometimes the start of payments for those programs are delayed. And when the client finally starts receiving payments, they'll get a lump sum. That lump sum should not be included as income. So like client gets $2,000 of lump sum, but really they're getting $500 a month. You'll use the $500 figure per month to project for that annualized amount. In terms of welfare assistance, please exclude SNAP and WIC from line 4. Row 7 or line 7, a bit complex. So if the client is earning interest, dividends, or other net income from real or personal property, that will appear here. Okay, if your client has $5,000 or less of assets, you're kind of on easy street. You can just work this first sentence. If you're in a situation where the family/household has more than $5,000 of assets, it's a little bit complicated. You have to come up with 2 data points. The first, the actual income derived from the assets. And the second one is the current passbook savings rate times the value of the assets. So a quick example on this. Household has $10,000 worth of assets, and they draw $200 of interest on those. And you have that documented. Okay, so we have $200 of interest, but if you were to apply the passbook savings rate, which last I checked, and don't quote me on this, last I checked was 0.45%. So that would be 0.0045 times 10,000, $45. $45 is less than 200, so 200 would appear on this line. Okay. My hunch is that you're not using line 7 too extensively, except for the first sentence of it. Okay. I did plug in an example here so that when we get to the lower part of the form, we have more to go off of. Part 2 is the allowances. So plug in the number of dependents you have. Foster children do not count as a dependent in this calculation, so please exclude them. $480 per dependent. You have the $400 allowance for elderly or disabled head of household. You can only claim one of those. And then these are unreimbursed expenses, rows 13 and 14. So if there are unreimbursed childcare expenses, and these are childcare that enables someone to work, look for work, or pursue education, you can claim these here. And a child is 12 years or younger. I mean, for this purposes, that's what's intended. And yes, the childcare expenses for foster children can appear in row 13. Row 14 is similar in a way. 14A is for disabled family members with a disability, and it's either for attendant care or an auxiliary apparatus. A couple of examples of an auxiliary apparatus would be a wheelchair or a ramp, and that this attendant care or auxiliary apparatus enables that person or another person to work. And then any unreimbursed medical expenses for an elderly person or someone with a disability. Rows 14A and B will auto calculate here in this gray cell. And then the allowance is however much this exceeds 3% of annual gross income. So let's just pretend I had $800 in this cell. Well, 800 minus 720 would give $80 allowance for the medical expense deduction. Section 3 is quick and easy. Everything's auto-calculated. We're going from gross income to adjusted income, then down to monthly adjusted income. And this is where we all can take this form in different directions in a sense. Yeah, because all of everything up above was straightforward, but down below there are some departures depending or different ways of going about this depending on the project type and the client's particular situation. We'll get into that in a moment. Okay, so
Hey, Wes.
yes.
Sorry, I just want to jump in for a second for clarification. Rose had a great question. So I don't know how many of the folks on the call operate more than just CoC rental assistance. If you operate ESG or HOPWA or housing choice vouchers, I know there's several that operate in many or all of those different programs. Just for clarification, some of the numbers on that spreadsheet, if Wes, if you could toggle back to the worksheet again. Some of those numbers for some of the other programs that HUD runs have increased. HOTMA, the Housing Opportunity Through Modernization Act, has gone in effect for all of the public and Indian housing programs, including housing choice vouchers or Section 8. I believe it's gone in effect for, or it's in the process for HOPWA, but not for ESG or CoC. And it is just a great time for those of us who work on all of those programs because you'll notice some of the numbers in this form. You're like, wait, my other form that looks almost exactly like this has a different number. That's intentional. It's very frustrating, we understand. But keep asking those questions. It's a really good one. So thanks for that, Rose.
Yes, and if you go to the regulations, they have the HOPMA figures, like 50,000 instead of 5,000. If we went over to the deductions, we'd see like 525 instead of 400 for the elderly head of household. So thank you for highlighting that, Rose and Megan. Um, yeah, CoC has not been allowed to use HOTMA yet, so we have the old figures. Great question. Okay, resuming, now we're getting to the part where we determine how much of the rent the client slash household is responsible for. So this is a little bit geared toward PSH, kind of the way it's set up here. But remember, household is going to pay the higher of 30% of adjusted income or 10% of gross income. In my example, the client is responsible for $588 a rent of a monthly rent charge of $1,000. And that means the agency's paying $412. Okay. If if the setup is where all of the utilities are included in the rent, then you are done. Stop using this form whatsoever. And we also need to share the utilities in question for CoC. The eligible ones are electric, gas, oil, garbage slash trash, sewage, and water. And those utilities are listed on HUD Exchange. Okay. A more complicated scenario, but not unsurmountable, is if the client has one or two utilities of the five I listed that he has to pay on his own. They're not included in the rent. So that's where the utility allowance tab comes into play. So we hop over to the utility allowance tab. We have the current utility allowances hyperlinked. And I want to go look at those allowances real quickly. Someone had a great question earlier this week, one that I had asked our real estate team. So here's the web page for the utility allowances. We have single family and multifamily schedules. Choose appropriately. But a couple things I want to say. First off, and this was the question, you can ignore this expiration date. If we went to HUD's website, we would find this form, and IHCDA has been reusing this form for the last 3 or 4 years. I just want to reassure you that these 2026 utility allowances are good through the end of this calendar year in spite of what this reads. I think this means that HUD may update this form and project a new expiration date. IHCDA created this, or at least they went live with this utility schedule in December. And this is organized by county. So all 92 counties alphabetically. And you can, if you CoC subrecipients, you can disregard the internet utility. So basically you can disregard all the even number pages in this schedule because internet is not a CoC eligible utility. We'll go back to the worksheet in a moment. My imaginary household was a mother and a child, and it was more appropriate given the ages and genders, sexes, to have 2-bedroom. And then in my example, I just imagined that their one standalone client pay utility was electric. So I used, and they're living in Adams County, the 2-bedroom figures here on the schedule. And I neglected this part, but I would also put in this information. And the appliances that apply and all types of electric got $218. That figure then populates from the third tab over to here, and with the utility allowance, that dropped the household's monthly rent contribution to $370. And the agency is now paying $630. Yeah, so that's a run through. But I do want to share a couple more resources. I discovered this recently, but HUD has a really great notice, and it's specifically on what we were just discussing. When the program participant is responsible for one or more utilities, how do you go about the rent contribution, occupancy charge, or utility reimbursement? It's pretty hard to impress me a lot of the time, and I was honestly in awe of this resource. They have many, and I created a highlighted version. It's just such good content about all things CoC utilities. I won't go on too much more, but if you've ever wondered like how to go about reimbursing the client for utilities, they on page 9, they have the 2 different ways you can go about that reimbursement payment. I think I was showing you, they have 6 different examples of how to handle the income and rent calculation based upon the client's situation. And I don't think there are any other scenarios that could be captured. I think they hit all of the possibilities with specific examples. And then last point, I promise. If you're kind of not clear on which of the budget line items in CoC funding can be used to pay for utilities, that question is answered very well here for both PSH and rapid rehousing on the next page. So I created an overview of the high points of this training. And here at the bottom, I really added the CPD notice, as I think it offers you the specificity that the regulations don't. And I think as far as utilities influence CoC income and rent calculations, I don't think it'd be really hard not to find your answer in the document I was showing this one a moment ago. So, and yeah, Megan and I, we're going to send out some other resources. That CPD notice I was showing a moment ago, we'll put the worksheet on the follow-up email. You've got that one pager I was just showing you. And of course, we'll send the slideshow and recording. So, all right. We're at 11:50, so I think we'll turn it over for about 5 minutes of Q&A. And I think if you're not interested in asking questions, then this could be an opportunity to fill out the feedback survey we're requesting. And of course, you're not beholden to us. Anytime you need to drop off, feel free to do so. Okay, so we've got a question about the internet utility that Megan's answered. Awesome.
I will say, this actually may apply to a couple of you. So the inclusion of the internet is something that HUD allows for certain tax credit properties. Um, there are some of the tax credit properties throughout the state that were required to provide internet, but not required to pay for it, which can apply to several of the PSH properties. Um, the um, sorry, the compliance team on the real estate side is allowing for utility allowances. So that's kind of why it's a little bit confusing that they're included in this sheet. Um, for right now, unless you are in one of, and most of the time for the PSH properties that are funded and have that internet utility, the property itself is usually covering it. So if you have a tenant in a tax credit property and internet is one of the expenses at that tax credit property, reach out to us and we can double check if internet can be included as a utility allowance. It's like it varies from property to property, and most of the time it doesn't affect us on the CoC side. So I would say 99.9% of the time we can't include internet as a utility allowance.
Blake, your question is a good one. The income and rent calculation worksheet I was showing, it's already on the website. And so subrecipients are empowered to already use that. And if we introduce or update new forms, it's only fair that we do an email blast to accompany that so everyone can be aware. So that's kind of how we proceed if we introduce new forms. But yeah, no need to wait until the end of the year. You're free to start using anything on our webpage. Okay. Well, yes, go ahead, Lisa.
I'm always full of questions. Sorry, guys.
All good.
Um, so we have had this happen a couple of times where people are paid cash, and we have had a hard time getting the employer to fill out any type of employment verification form, type up a letter for us because they're doing things under the table. And so the employer doesn't want to put anything in writing. How do we go about that?
I I'm actually going to go to the regulations here. Big surprise, right? Um, yeah, so this is HUD and the federal government's answer. And then we can maybe get a little more granular here. But yeah, that's an interesting scenario. Okay, so and maybe this doesn't fully answer the question, but it's a start. So the record keeping requirements page, this is a huge page because like really what should be in the client file. Yeah, so HUD does provide some specificity on the income source documents. And then paragraph 3 reads, to the extent that source documents are unattainable, which seems to be the situation here, a written statement by relevant third party. Well, okay, well, we're not getting that, unfortunately. Or the written certification by the subrecipient's intake staff of the oral verification. So I think, yeah, I'm kind of reading this off the fly, but at least I knew about it. I encourage you to read these two paragraphs, and I think you writing a statement of how much, the client's being honest and how much they're receiving in pay, and that you did your due diligence to try to get the employer to provide more official income source documentation, and making ample case notes of this. I think that would be a responsible way of proceeding. And it seems like HUD might have kind of foresaw that possibility with these. So I don't know if that's a satisfactory answer, or Megan, you want to chime in?
Yeah, just a reminder, always tell the story in case notes. I think if we're looking through something and monitoring and we notice, wait, I don't see any pay stubs here, to back up what's on the income calculation. As long as there's, sufficient case note documentation, or if you wanted to even, I think that second paragraph said, in the event it's unobtainable, um, that then there could be a like written verification from staff, aka case note. So if if that's something that came up in compliance, just make sure that you would be able to tell that story to an auditor in your case notes.
Okay, thanks so much.
Welcome. All right. I'm going to close the session, but if you want to stick around and ask questions, feel free to do so. Again, we thank you for being here. Our next training will be Thursday, June 11th, and the topic is tentatively NOFO,
Oh,
right?
yes, yes. I'm so glad
Okay.
you said that. So
Okay.
in June, I think we were previously listed as RRH written standards. Um, we assume the NOFO for CoC is going to drop at the end of this month slash maybe the 1st of June. And so our June training will most likely be on the new NOFO and reviewing that for everyone. But we'll make sure we send out plenty of notice on what the topic will be if it does change.
Thanks again,
Thanks,
everyone.
everyone.
Enjoy the rest of your day.
Thanks, guys.
You're welcome.